Okay, so Assalamualaikum and good morning class. So in this video lecture, we will be discussing about working capital management. So in this first lesson, we'll be discussing a brief overview of working capital. Okay, so again, what is working capital, or some call this as the net working capital? So actually, this is just the excess of the current assets over current liabilities. So therefore, if we put this into an equation, the net working capital is equal to current assets less current liabilities. So we already know what are current assets, but as a review, current assets are the assets that are turning over, that are being turned over the production cycle or over 1 year, whichever is longer. So the main concept of working capital is from the a businessman who used cash and converted it into goods, and those goods were later on sold on credit and others for cash. So those goods are being turned over or rolled over as accounts receivable, then later on back to cash. So that is, they are the working assets. Okay, so there are two classifications of current assets. We have the permanent current assets. Okay, so what are permanent current assets? So this represent the minimum required level of current assets needed to support the firm's operation. So usually this is measured at the lowest point of the operating cycle to be conservative. Okay? So ito yung minimum required level of current assets, the cash, inventory, accounts receivable that are needed to continue the firm's operations. We have also the temporary current assets. So, by nature, the amounts of these assets fluctuate as the asset amounts needed to support these levels vary as well. Okay. So, we have here the current liabilities. So, again, these are the liabilities or the obligations that we need to pay within 1 year or um, within the production cycle, whichever is longer. Okay, so this is our self-check. Number 1, please answer. Okay, so what is the principle behind working capital management? Okay, so working capital management, this involves the process of determining the level, the quality, and the maturity of each major current asset and current liability, as well as the administration and control of current assets and current liabilities, so to ensure that they are adequate and used effectively for business purposes. Okay, so um, this determines the level. What is the level of our working capital management that is sufficient and adequate to fund the day-to-day operation? What is the quality of this? Is this conservative or aggressive? And what is the maturity? Okay, so later on in this lecture, we'll be discussing as to the matching of maturity of current asset and current liability as a proper working capital management. Okay, so we have here the following sources of working capital. So we have the net of working capital used in operations, and that is from the profitable operations. That's first. Second is the sale of non-current assets. So it can be also used as working capital. Third, the long-term borrowing. So of course, we already know that we will try to get financing so that we can invest in assets, and those assets will be used in operations and will later on generate enough from the operations to pay back the financing. So it's just the cycle, okay? And fourth, investment from owners. Okay, so this is are the following sources of working capital. So the profitable operation, so we already know this from the retained earnings, no? So if companies want to grow in their operations, to continually fund their working capital from day-to-day operations. So it needs profitable operations. So from retained earnings, no? So others, yun, from other non-current assets, borrowings, and investments from owners. So what are the uses? So the uses of working capital is first for operations. Okay, so working capital is needed so that the operations of the business is guaranteed. Okay, that there are really assets, there are really cash to pay the suppliers, there are really cash to buy the goods necessary, because if we don't have stocks, if we don't have inventory, no customer will come to us, to our business, and so therefore it's not really will be profitable, in the going concern. Second is for purchase of non-current assets. Okay, so we use the working capital to buy non-current assets that we can use for operations like the equipment, upgrades of property, and others. Third, retirement or payment of long-term debt. So this working capital, as they are working, no, so the it can be used to pay the long-term debt. Okay, so from the operations to channel to financing. Fourth, return of capital to owners through dividend payments. So except stock dividends, of course. We are talking here about cash. Okay, so cash operations, cash inflows, and cash outflows. So that is the concept of working capital. Okay, so in retirement of capital stock or for withdrawals. Okay, so self-check number 2. Okay, so now in our next slide, let's discuss the trade-off, inherent trade-off between the risk and the return. So of course, we already know that there's really a trade-off between risk and return. So the higher the risk, the higher the return. Okay, so how do we put it? So if we hold more current assets than our fixed assets, so this means a reduced liquidity risk. Okay, so if we have more current assets than more non-current assets, so of course, our liquidity risk is reduced because we have more liquid assets that we can easily convert into cash. Okay, and this means also greater flexibility because current assets can be modified easily. Okay, so we can increase inventory, reduce receivables, and others. But the rate of return of current assets is lesser than the rate of return being offered by fixed assets. Because fixed assets, so as what we know, the return increases as maturity or the term of the asset of the investment increases. So to compensate, the higher the longer the asset is being put into investment, the higher the return. So for current, let's say to make it clear, for instance, our investment in current assets. So accounts receivable are not actually generating returns because those are our investment at the hands of our customers at face value. We do not expect that our accounts receivable will be earning with interest, right? If you compare that with a long-term asset investment, for example, in securities or in stocks, they are or long-term assets. They are earning much higher return in interest. Okay, so that's just a simple explanation, no? Because fixed assets generally earn greater return than current assets. Okay, so long long-term financing, the long-term financing has less liquidity risk associated with it than short-term debt, but it also carries a higher cost. So in the perspective of cost also, the fixed asset, the long-term financing has less liquidity risk because you can pay that um, little by little, but for a longer period of time. Unlike the short-term debt, for example, maturing 6 months or maturing in 1 year, the risk of liquidity that we cannot convert cash easily is very high because of the shorter time frame. So we are pressured. Liquidity risk comes if we are pressured to convert this into cash easily. Okay, so the for long-term debt, of course, we are not really that pressured because we know we can pay it little by little only. So for example, a long-term debt of, let's say, 1 million, but in every year you are just obliged for, let's say, the interest of 10,000. Okay, so like that. So it's not that pressuring in liquidity risk as compared to a 500,000 short-term debt maturing in 6 months, right? So if you cannot pay the short-term debt, creditors will be putting pressures on you, will hold back credit lines, so your operations will be affected, and that is liquidity risk. Okay, so the trade-off here comes into proper putting of assets and liabilities. Because if we put too much, if we want to be conservative, we will be investing. If we want to be conservative, we do not want high liquidity risk. That's being conservative. We want to put too many or more investments in our current assets than our fixed assets. But if we want more returns, knowing that fixed assets generates more return, then we will invest more in fixed assets than in current assets. On the other hand, in liabilities portion, if we want lower risk, we'll go with more long-term debt, right? But if we want higher risk but higher return, we can have shorter time and then we can convert that and then we can make profit out of that financing, then we go with short-term debt. So now the trade-off here is on the risk-return trade-off. So it is very important for managers to determine the appropriate level of working capital. Okay, so there is no one-size-fits-all here policy because bottom line, managers have their own way and distinct way of determining working capital levels. So we can measure a risk appetite of a corporate manager by looking at his or her working capital policies. Okay, so how did she manage working capital in their company? So is it more conservative or is it more risky but aggressive? Okay, so we can determine, so there's just a theory for determining the appropriate working capital level, and that is the rule, the self-liquidating debt or the hedging principle. So this hedging principle, this is not a one-size-fits-all, but it is a good starting point to follow when making working capital decisions. So this hedging principle states that we should properly match the assets with the liabilities of similar maturity. So if we want to finance assets, so if we will finance short-term assets, it is proper that we will match it also with short-term debt. The same with if we match long-term assets, if we buy long-term assets, it should be financed or we buy that long-term asset using a long-term debt. So that is what is hedging principle is all about. So therefore, permanent asset investment should be financed with permanent sources, while temporary investments should be financed with temporary sources of financing. Okay, so just to show, this is an example of working capital management using a conservative approach. So as you can see here, let's use a highlighter. There is a very high level of long-term financing here. This one, the long-term financing is proportionately higher than our short-term financing. So look at our short-term financing. So it is just on this level. Okay? While long-term financing finances almost all. Okay? So as you can see here, the fixed assets, okay? The fixed assets are, and the permanent current assets are actually being financed by long-term financing. So therefore, in this approach, there is definitely low risk. That's why it is conservative approach. Okay, so there is conservative approach because it is low risk as regards the payment of the long-term financing, and that the we can see here that the temporary current assets are, some even are actually being financed by long-term financing. Okay, so the only trade-off here is a lower return. Why? Because you are actually maintaining a relatively higher level of idle liquid current assets. Okay, so too much current assets um, here. Okay, so it can be idle, not really generating that much, because as I have mentioned a while ago, accounts receivable, if you put too much investment in accounts receivable, you can think of the opportunity cost if you invest that into a much higher yielding, interest yielding long-term investment. So let's say, for instance, you put that in a money market instrument or bond investment, or in the um, other much profitable money market financial market instrument, it will earn more by interest. But if you put too much in the accounts receivable, just to make sure that you have lots and lots of current assets that can be easily converted into cash, no, the current and the quick assets. So if you put too much investment in that, that is actually not generating too much profit for the company. Okay, but in general, this approach is what we call conservative approach. Okay, so time for self-check number 3. Okay, so this chart here shows an aggressive approach in working capital management. So as you can see, there's only okay, little current assets. Okay, and these current assets are actually being financed by short-term loans. And the long-term assets, or the fixed assets, are being financed by long-term financing. So as you can see here that um, financing the current assets with short-term debt, this puts higher liquidity risk, because you really have to be on the loop, no? You are always your eyes should always be set on schedule, that you need to pay it as on time as possible, so as not to um, affect the creditor relationship with your supplier. Okay, so this approach is much aggressive, but this may be aggressive, but this generates higher return, because as you can see, it's the investment in idle liquid current assets is put to a very minimal only. Okay, so most of the current assets are actually earning higher. Okay, so this approach is what we call the aggressive approach. Okay, okay, so let's try to answer self-check number 4. Okay, so in this series of video lectures under working capital management, we'll be discussing about cash management. We'll be discussing about marketable securities management, receivable management, inventory management, and liability management, particularly short-term liability management. Okay, so that ends our lesson 1 under working capital management. So next lesson coming up, cash management lesson 2.